On to the next segment, which is actually segmenting the opportunities in property. Marius tells me he's been warming up his vocal cords and he's ready to go. So welcome to the stage, the panel.
Thank you very much, and thanks for having us here today. This session is a session that is very popular with everyone. Property, everyone's got a view. It's been a really tough time since COVID. So, getting the latest insights on property and being able to answer some questions that I'm pretty sure you will have many is the objective of the session. Before we introduce our panelists and speaker, I just want to say it's such a great industry we're in. We go through these times of trials, and it's in times of trials that we learn. So, if you think about since COVID to now, just what's happened in our industry, what's happened in the markets, what's happened in our sector, it's been incredible. The other thing that I enjoy about our industry is there's always something new that pops up. So this morning I was reading the AFR and a new phrase came to me. Why lender-on-lender violence is on the rise. It's like, what is that about? Anyway, so that's only our sector. So without further ado, let me introduce Chris Davitt. So Chris Davitt is a fund manager at Dexus. Chris has been managing funds for a very long time. I won't say how long, offshore and locally. So Chris will do a bit of a review of the sector, and then we'll have a discussion after that. And we also are very fortunate to have Jennifer with us. So Jennifer is a senior consultant at JANA and also part of their real estate research team. Jennifer previously was involved with industry super funds, don't hold it against her, and also in the unlisted real estate and infrastructure space. So Chris, I'm going to hand over to you to do a quick overview of the sector. Thank you.
Okay, thank you, Marius. Good afternoon, everyone, and it's a pleasure to have the opportunity to join you today and to share the stage with Jennifer and Marius. My name's Chris Davitt. I'm the fund manager of the Dexus Wholesale Australian Property Fund. This is a $1.9 billion fund that owns 24 office, retail, industrial and mixed-use properties around Australia. And my job today is to frame the topic. So what I propose to do is take a look, take stock basically of what's happened over the last 5 years. I think that goes to say a lot about why we are where we are. And then I want to look forward and draw some conclusions based on that sort of background about where we might be going looking forward. So where to begin? Well, let's start with the 2019 Melbourne Cup. In real estate circles, there's an old adage that if you want a transaction done and it's not up and running by Cup Day, then you've missed the boat for the year and you can just enjoy the Christmas season and the IMAP conferences. In 2019, the local horse Vow and Declare was the winner. And as the year drew to a close, I'd hazard to say that most of the real estate industry was feeling pretty good. I was. Returns were on track to come in at about 7% for the year. That would make a full decade in which each and every quarterly return between 2010 and 2020 had been between about 7 and 9%. And no matter what the time frame, 1, 3, 5, 7, 20, 35 years, all the returns were about 7 to 9% as well. But then it came along the COVID 2019 pandemic, which was shortly followed by a global outbreak in inflation, which triggered a dramatic rise in global interest rates. We all know this story. But over the same time frame, there's been a number of other tectonic developments. Skip ahead. Firstly, the pandemic supercharged the uptake of cloud computing and video conferencing, which made working from home possible during the lockdowns. 4 years on, I think we should firmly regard part-time working from home as the ingrained new norm for most white-collar workers in Australia. It follows that there will be a step change in demand for office property. We'll need less space than we might otherwise have, and then the normal trajectory should resume. But now that we're nearly 5 years down the track, there's been plenty of time for tenants to adjust their space requirements and developers to tap the brakes on supply. So I think we're very close to a point where the structural impact of COVID is fully washed through the system. with the caveat being down in Melbourne where the lockdowns were longer and the recovery time is going to be slower. Zoom's revenue figures on the screen are a good proxy for this phenomenon, with both the step change and the plateau clearly evident. The second thing worth acknowledging is that construction costs have increased tremendously. Officially about 35 to 40%, but anecdotally much more than this over the last few years. And the third major shift is that in the last few years is that Australia's population has grown by a lot. The ABS estimates that since December 21, the population is up about 6.5%, which is an extra 1.65 million people. So what does that mean for the short, medium and long term? Well, firstly, it's ruined my chart. You know, the one with the great returns for the last 35 years, not looking as good right now. The sudden rise in interest rates from record lows to 10-year highs has caused prices to fall across the board. In my world, cap rates, which work the same way as bond yields, have gone from about 5.25% to 6.5%. Though in the last two quarters, both June and this upcoming quarter, the cap rates have been stable and the valuations have actually nudged up a tiny fraction. I think they've been stable because bond rates look like they've peaked at 4.9%, 4.99% in the last about 12 months ago, and now we're sitting somewhere between 3.85 and 4. Now that you've got that peak well and truly in the rearview mirror and the chat very much turning towards rate cuts from here, I think we're getting to a point where equally you can say that this impact has also been fully baked into both pricing and valuations. The interesting thing for the longer term is that investment values have been falling, or as they've been falling, replacement costs have been rising. This is due to supply chain disruption, high land costs, high materials costs, high labour costs, high financing costs, and the difficulty of finding a builder and repricing of development margins to reflect all of these substantial changes in risk. We estimate that the properties in the Wholesale Australian Property Fund are being held about 30 to 40% below replacement costs now, and I've seen other analysis that suggests that this is indicative of the broader market, with CBRE coming out last week and saying something similar in one of their research pieces. One of the reasons that real estate has a reputation as being hedged against inflation is that imbalances like these don't typically sustain over time. If replacement costs skip ahead of investment values, then investment values will catch up, and vice versa. So how is this likely to play out? On the demand side, if there's an extra 1.5 million people in the country, there's a fundamental need for more places to live, work and shop. And it would seem very unlikely that that demand's going to go away because the population retraces to where it was in 2021. On the cost side, it's equally unlikely that construction prices are going to come back by 30 or 40%, particularly when labour is a big component of that, and we all know that wages are sticky. And on the pricing side, we're not going to get interest rates back down around zero anytime soon. And so I don't think that's going to be enough to, or any sort of cap rate compression is going to be enough to close the gap between where investment values are and where replacement costs are. So that basically leaves us with rents. If there's not much give in any of these other factors, then you'll need rents to rise in order to justify new construction. Let's say we're right and we get 10 to 15% rental growth over the next year or two. An immediate reaction to this would be further price appreciation, not due to lower interest rates, but just due to buyers becoming more active and a resumption in normal levels of competition between buyers and sellers. This could easily add another 5 to 10% to prices, and all of a sudden values have been restored to around replacement cost, which doesn't sound crazy. Real estate's throwing off an attractive yield due to the rental increases. Investors who act now are very, very happy, and most importantly, my returns chart would again be looking much more like it used to. So that's sort of how we see the really big picture in terms of some of the opportunities. We like retail for a number of reasons. The supply chart, the supply's been trending down. You can see that on the chart on the screen. Rents as a percentage of sales turnover have come down in the last few years. So they typically, rents will be quoted in terms of the market rents as a percentage of what the tenant is generating in turnover, and that's down, which indicates that there's room to grow. These assets are actually very flexible when you, in terms of being able to remix them, to adjust your tenant base to reflect the current share of the consumer wallet. For example, within our portfolio, we've made a conscious effort to move away from retailers that just stock low-margin generic goods in favour of personal services which reflect what people want. Services often can't be replicated online, and they're often run by very high-quality professionals that run good-quality businesses and are able to pay strong rents because they've got good businesses. And of course, retail's supported by that population story and unemployment sitting around 4.2%. In terms of office, we're of the view that there's a building undersupply within the Sydney CBD. Indeed, there's no buildings expected to complete in the whole of FY26. That is unusual. Brisbane also screens pretty well here in that it's a diversified economy with a growing population set to benefit from the Olympics in 2032, and it wasn't locked down anywhere near as long as, say, Melbourne, which means that there's been a return to the return to work has been accelerated, and indeed effective rents are actually on the move up in this market. And industrial, it's been well documented that Australia needs more industrial space, but that supply has been somewhat restricted by slow infrastructure rollouts. In this space, we're very conscious of the fact that transport costs can be up to 70% of a business's supply chain cost, whereas their fixed facility fees, in other words, rent, is only sort of 6 to 10%. So if you can provide your customers, the right customers in the right locations, which minimise their transport costs, then not only are they sticky, but they're likely to pay a bit more in rent, and you can do well in that sector. And finally, in residential, I think that's a really interesting space. We need more housing choice in Australia, but we probably also need ways to live off our capital. This makes sectors such as the purpose-built student accommodation, land lease developments, co-living, build-to-rent developments all interesting, but the high construction costs has made this hard to stack up, and you do need to be highly cognizant of political risks that might arise when you're investing in owning people's homes. My final observation is that this whole presentation sounds a little self-serving, doesn't it? Fair enough. But my last proof point, I think, is a good one, and that is take a look at who's doing the buying of commercial real estate at the moment. And the short answer is that it's the wealthy private investors. They're the ones that are seeing the opportunity. These are people that have been through previous cycles and tend to be focused on this arbitrage between what it costs and what you can buy it for. There's a long history in this country of people making it big in one particular sector and then storing their wealth in real estate. And amongst the many column inches that was the triumph of Air Trunk over the last month, you know, there's a little side story that even Robin Cooter in the last few years has been stashing away his excess billions into a little real estate side hustle too. So if it's good enough for him, it's probably worth taking a look at real estate for your clients too. Thanks very much.
Thank you, Chris. A friend of mine says I always back a horse called self-interest, and so Chris was quite over there about sort of his self-interest. So Jennifer, from a client perspective and independent consultant point of view, what are your views on where we are in the cycle, particularly that you've heard what Chris has had to say?
Thanks, Marius, and thanks for your comments, Chris. In real estate, investors have had a hard time of it. 8 quarters of negative growth, that's pretty hard to swallow. And in SAA, in a strategic asset allocation sense, markets have been really volatile. So we've seen clients' property allocations bouncing around a lot, which is really challenging for investors to navigate through. I have to say the JANA House view at the moment is that we're nearing the bottom. So I think Chris and I are in agreement in a lot of respects. We still have concerns. There are still some very large redemption queues out there that need to clear, and incentives in the office market are still very high. So we're not saying it's all smooth sailing from here on in, but we think it's a really interesting time in the market just at the moment.
So you'd agree then we sort of there or thereabouts?
There or thereabouts, yes.
We'll come back to the office in particular and looking at assets as well. You look after different kinds of clients from the large end through to the small end. When you're looking at real estate, the asset itself is just part of the story. There's obviously structure, gearing, tenant diversification, all those issues that come into play as well. How do you advise your different clients in that regard, the different types of clients?
Yes, it's very much a client-by-client advice model, and it needs to be. Everybody's got different needs, different liquidity requirements. Some have ability to invest in unlisted, but not all. So some have the listed market only. And certainly debt is a big factor. Debt will enhance positive returns, but also it goes the other way too, and will enhance, for the downside is much deeper. So certainly structuring is always an issue, and the specifics of the asset, the tenancy mix, the longevity of and resiliency of the income is vital.
Thank you. This is another cycle, and Chris, you mentioned some of the smart money's gone through a number of cycles. For both of you, is there anything different about this cycle that should make us think differently about this prehistoric asset class called property?
I think one thing that's different about this cycle compared to, say, the early 90s crash or even the GFC is that it's all on the capital market side. Operationally, across the various asset classes, things are okay. I think Melbourne office is not good. But taking that out, and there's always a weak spot within any market. On the retail side, at Dexus and across the board, I think landlords have nursed their tenants through, and we're coming through to better times. The occupancy is okay. On industrial, it's been quite strong, and even in office, it's not too bad. If you've got a good quality portfolio, and that's a little bit different. Normally, a big property downturn is associated with much more pressure on the operational side, whereas at the moment, delinquencies are very, very low.
Yeah, just to add to that, there's a lot to like about the built environment. It's where we live, we work, we eat, we play.
We have conferences.
We have conferences, exactly. So, none of that has changed. One thing I'd like to point out is sustainability is now a very key component of a particular asset, and that has created a bit of bifurcation in the market between the good quality assets where tenants want to be, where employees want to work, where retailers want to be, versus the others. So we're seeing a lot of bifurcation in the market.
Thank you. And before we go to sectors, probably just one fundamental kind of question. The concept of replacement costs has come up a number of times over the last few months in conferences like this. Chris has put up his replacement cost theory there. Would you agree with that? And how does that play into valuations?
Absolutely agree with what Chris put up earlier. One of our G-REIT managers did a study not that long ago on replacement costs and came up with a very similar number that's sort of 30 to 40%, but may well be larger in terms of the way costs have gone up since pre-COVID times. And that certainly means less development activity, and less development means, we're not going to be supply constrained in the near term. And Chris made that point too.
So, Chris, do you just want to expand on what your message was around that? Why is that such an important driver for value looking forward?
Yeah, I mean, we were talking about this earlier with some of the guests here, that there's different ways to approach valuation. On the one hand, you've got the valuers that will try and look at the rent roll, take the present value of that, make an assessment of what it's going to be worth in the future, and applying a discount rate, they come up with a number. On the other hand, you've got the listed mark, and they'll tell you what it is worth day to day. Who's right, who's wrong? That's a eternal debate. But the third element, and that's absolutely legitimate, as are the other two, is what it costs to build. So what you can put the land in for, what the raw materials are worth, what the labour's worth, the financing costs, the incentives you have to give away, all the professional fees, and then a risk factor. And I think to Jen's point, that ESG component comes in here too, in that there'll be a bunch of new building that does have to take place in order to just not only meet population growth, but to continually improve the stock. And I don't think it's just going to be a question of, well, we don't need it because we've got a little bit of excess here. That'll be left behind, and you'll still need for tenants to meet the market in terms of providing new stock, so they're going to have to pay a bit more in rent in general, and that's why it has worked. In real estate was typically put into the portfolios of the major institutions in the 70s and the 80s when we had higher inflation, when 5% was nothing unusual, and it was so that their members kept up the real value of their investments kept up, because at the end of the day, if the price of concrete's going up, then that will play a part in terms of determining the long-run valuations of real assets.
Thank you. And I just want to give you enough time for questions. I've got a host of other questions I can go through, but it's more interesting when there's a bit of interaction from the audience. So has anybody got a question that to the panellists? So, Michael, I told you not to ask that question, Michael.
I can't ask Jen this question. But Chris, retailing, you sort of skirted on retailing and sort of had a positive view on it, but I just wonder, there's two significant factors that seem to be playing out there. One is the economic cycle, which obviously with high interest rates has been quite negative, and the impact on discretionary spending. Now that you could argue may get better moving forward as interest rates ultimately get cut. The other one I'd be interested in your comment on, though, is the structural phenomenon on shift to online retailing and the impact that may have longer term on bricks and mortar retailing. Can you perhaps comment on that? Because that seems to me to be something that, we underestimated the work from home longevity and its impact on office space. I'm just wondering whether we're underestimating that as well.
Okay, yeah, I think both have a COVID component to them. The old adage that you never waste a crisis is not lost on leasing executives. And when COVID came along and, they got budgets to meet, they all got the red pen out nationally and slashed the rents on what you could ask for in retail, which, through to about 2018, basically the day that Frank Lowy sold Westfield, had a 20-year bull run. So the rents were reset from there because no one was in the shops. You had to, whether you did it commercially or whether it was government mandated, you weren't allowed to charge rent. There was no one standing behind, and everyone took a pragmatic view that we just have to eat this and move forward. We moved from that into a rapidly rising interest rate environment, and then all the chat was about the cliff. And of course, as it's been mentioned, recession's been predicted for a long time. So there's been a whole lot of rational reasons why rents would have been put down at a level that was sustainable and with a pretty negative view from landlords as to what the future would hold. Now, I think that as it turns out, as we stand here today, we're largely through those things and we're probably in better shape, and we certainly are seeing an ability to get extra rent. And you're seeing that in the listed market through their reporting too, in terms of what they'd refer to as spreads, what you lease new space for versus what it used to be leased for, have gone from negative to positive. So I take your point in terms of there are pressures out there, and of course it's always a question of balance, but I do think overall we're in a position where rents are sustainable and can grow, because the last element there is that the retailers, at the end of the day, their revenues are higher due to 15% or so cumulative inflation over the last few years, boosting their revenues, and rents are generally a function, like a fixed function of that top line number. In terms of the more structural impact, I touched on it quickly but didn't elaborate. I think the team have done a very good job within the business of positioning for online. And these days it is true that there are a lot of services and fresh food. Fresh food is an anchor, and then you've got a whole bunch of personal services, be they doctors, dentists, physiotherapists.
Barbers. Not that I need barbers, but barbers.
Yeah, exactly. Personal services, gyms, nail bars, aromatherapy, they dominate the rent roll, and you just can't do those things online. And you do have very qualified people that it costs you $250,000 for a dentist chair, and an X number of years at university. So if you're getting those into these places, and I think these places bring credibility to services which are hard to judge, but also customers to the shopping centre, they're more flexible than you might think in terms of being able to position for structural changes.
Thanks for that succinct answer, Chris. So any other questions?
Yep.
Yep, sorry guys, just over here. Maybe.
Yeah, happy to go. Chris, your view in terms of residential market moving away from standalone houses to high-rises, given the incoming growth in the population and utilities cost to wire up more land, do you see a view going long-term that there could be a potential in Australia where you have just high-rises as apartments, similar to a Hong Kong real estate market?
There's definitely been that shift that, there's been an encouragement from a policy perspective of densifying what we've got rather than continuing the urban sprawl. I don't think we get to Hong Kong type proportions, but there's, whether it be Brisbane or Melbourne, that is, the focus on that has increased. And I do think around major transport nodes, you're going to get extra height, and there'll be winners out of that, actually, and hoping to be one of those.
At the back there.
Yes. Sorry, just I might have missed it, but did you run through the vacancy rates? I know we were, as far as the major capitals on commercial, but also do you think that the commercial properties inside large industry funds have actually been revalued, so they're now reflecting the real valuations in the market?
Maybe I'll speak to the valuations, and Chris, if you could speak to the vacancy rates. But in terms of valuations, yes, we've now seen some transactional evidence in the office space, which is really exciting and a really good thing for the market, seeing that clear, and that provides anchor points for valuers. So yes, we've seen some of that come through. There may well be a little bit more to come, but as I said earlier, we think we're nearing the bottom.
In terms of the major sectors, there's not much vacancy in retail. In industrial, it was very low, but you have seen an uptick in sublease vacancy. That's come off a little bit. And then in terms of the major capital city markets, Melbourne is around 20%. That's high. Sydney is in the sort of mid-teens, and it's sharper than that, and heading the right way in Brisbane and Perth, where the markets are, again, there's that long shadow of COVID is not so long in those markets.
So, look, we're out of time, but if you want us to carry on for another 2 minutes, who wants us to carry on for another 2 minutes? Yeah? Okay. All right. So thanks for the vote of extra 2 minutes. So the question just, we have to look forward. So if you had a dollar to invest in the different commercial real estate sectors, where would you be placing that investment right now if you had to make a sector choice?
Look, JANA view is diversification. Otherwise, you end up with a whole lot of idiosyncratic risks, which, on single assets, so that becomes problematic. But having said that, I think with some of the transactional evidence that we've had and the resetting of values, and in certain instances, there are distressed seller situations, and I stress it's the selling that is distressed, not the asset. So high quality, good quality assets in prime locations, but an asset owner needs to sell, where you can get discounts. I think there's some really exciting opportunities that will be emerging.
Thank you, Jennifer. Chris?
I'd agree with that, but if you, in terms of just a thematic, I'd go with retail, because I do believe the long reasons articulated that there's an ability to grow the income, and at the end of the day, that is where your sustainable growth comes from.
Thank you. And I'll wrap that up by saying clearly in a retail portfolio, diversification is important. And what was really pleasing this morning, like the early session was talking about fundamental and quality and active and all of that. Within real estate, you have to look through the label. You have to look through at each of the assets. You can't just take the headline that you read in the AFR. So thank you very much to Jennifer, thanks to Chris, and thanks to Toby and Francie. Thank you.